Hello, and welcome to the Frontier View webinar on the Outlook for Northeast Asia 2021. I'm Althea Han, Client Services Manager for Asia Pacific at Frontier View. Before we get started, we realize that some of you may be new to Frontier View, so we'd like to take a minute to provide you with a very quick overview of our firm and how we work with executives at major multinationals. Frontier View provides the world's best market intelligence and advisory services for global business professionals. We help our clients grow and win in their most important markets by informing and powering the market monitoring, planning, execution, and other critical decision processes of our clients. With continued research and insights, custom solutions, and transaction support services, we provide our clients a small sample of which you can see here with timely, actionable insights to adapt and win in changing markets. If you are not a client and are interested in receiving a 60-day complimentary access to our Frontier View program, please leave a comment in the chat box or email us at info@darkerfrontier.com. As part of our offering, we are excited to announce that we have recently launched a new mobile app. Frontier View Mobile, which is available on both iOS and Android, includes all the relevant content you need to monitor markets, including this webinar recording and presentation deck. We encourage you to download the app to have access to these insights and more at your fingertips. Current clients can access the mobile app using the same login information as our browser application. If you are not a client, you can still download the app and start monitoring up to 5 complementary countries and access other features like daily news and notifications. Having briefly introduced our company, I'd like to take a moment to introduce our presenter for today. On the line for today's webinar, we have our analyst for Northeast Asia, Boyang Xue. Boyang supports senior executives on key initiatives, including strategic planning, resource allocation, and risk management for their Northeast Asia portfolio. Because Boyang is in constant contact with our clients, he will be discussing not only the results of our research, but also what we have been hearing from multinationals who are being impacted by the coronavirus. If there are any insights you see today as part of this discussion, or any questions we don't get to answer, our client services team, Sarah, Vivian, Yuchen, and I will be happy to follow up with you directly. And with that, I'd like to turn things over now to Boyang to take us through our agenda.
Thank you, Althea. And good morning, everybody. Thanks for joining today's webinar. Our webinar today will consist of a 15-minute presentation, followed by Q&A. To be specific, I will begin the discussion on how China, Japan, and South Korea are performing relative to their peers in the Asia Pacific, as well as around the globe. We'll then take a closer look at the economic outlook for China, the shape of its economic recovery, and how different sectors are likely to recover over the next 12 to 18 months. We will then discuss the outlook for Japan, highlighting the impact of the outbreak on its economy and what its recovery looks like. Finally, we will discuss different dynamics affecting the outlook for South Korea. At the end of my presentation, we will round out the webinar with a Q&A session. So if you have any questions or points of clarification regarding any of the topics that we covered today, please do not hesitate to send them to Darker Frontier Webinars via the GoToWebinar Messenger by clicking on the Q&A box on the right-hand side of your screen. And we will do our best to ensure that they are addressed in a Q&A session. So without further ado, let's dive in. So starting with the global and APAC context and see how the Northeast Asia market is performing relative to their peers. Now, 2020 is obviously an unusual year for the global economy, with COVID-19 ripple through different markets and different economies around the globe. So as you can see, there's pretty great divergence among different countries and markets when it comes to growth projections for this year as well as next year. And we believe that the Northeast Asian region as a whole is going to be relatively more resilient compared to most other markets. However, there's still pretty significant divergence in growth numbers and trajectories between China, Japan, and Korea. So as you can see, we expect China to be the only major economy to avoid an economic contraction in 2020. And we expect Korea to be one of the more resilient, if not the most resilient, advanced economies in the world. However, unfortunately, Japan is going to be pretty hard, going to be hit pretty hard by COVID-19 this year, as we can see that it will experience an above 5% economic contraction this year. And when it comes to the region, the same dynamic also remain. There's great divergence in growth among different markets in the Asia Pacific. As you can see, China and Vietnam are likely to be the only two economies to record a positive growth number for the current year. For the next year, we still expect China to be one of the fastest growing regions, one of the fastest growing economies in the region. However, South Korea and Japan will still be in positive territory next year, but the growth is going to be significantly lower. And also, we shouldn't ignore the fact that because of base effects, a lot of the growth numbers for next year are actually propped up because these economies experienced economic contraction this year, so that will prop up the numbers for next year in relative terms. So how exactly are these countries going to recover, and what factors are determining the shape of and the pace of their recoveries? Let's take a closer look right now. Well, China, obviously being the first one to get into the pandemic, is likely going to be the first one to get out of it. So as you can see in this slide, we expect China's growth to slow to 2.2% in the current year, before ticking up to 7.8% in 2021. This is obviously because the coronavirus has sent significant shockwaves to the economy through the demand side as well as the supply side. However, the Chinese government has taken some actions to shore up the economy, which allows the economy to get back on track, especially following the containment of the coronavirus sometime in Q2. And now the economy is going to continue recovering over the next few months. And however, the economy also remains deeply uneven, as we will explain later, the dynamics over there. Needless to mention, the dampened global demand for Chinese exports and the expected weakness in future global recovery is also going to weigh significantly on China's exporters. So we think that there are very important signposts for companies to watch for, and these are laid out in on the slide. Looking at the shape of China's recovery, we do expect the economy to continue recovering over the next 12 to 18 months. So for the current quarter, we project 5.2% growth, and then we expect the economy to trend up to 5.6% for the last quarter of this year. Next year, as you can see, there is likely to be a significant surge in GDP growth in Q1 because of base effects, and then gradually slow down toward the end of the year. However, this trajectory is still going to allow China to reach an almost 8% growth for 2021, according to our estimates. And in absolute terms, the Chinese economy was able to experience a so-called V-shaped recovery, following the peak of COVID-19. And then we do expect the economy to gradually recover. In absolute terms, it will continue recovering and overseed its level in 2019 in the next 12 to 18 months. And obviously, the major contributor to China's growth right now, and the major pillar of China's economic recovery, is the fiscal stimulus enacted by the Chinese government toward the end of Q2. To be fair, this stimulus is not as aggressive as some of the other fiscal stimulus we saw in other economies. In fact, it only accounts for about 4% of China's GDP, or about 3.6 trillion RMB. However, nonetheless, it has kicked in and has supported growth in China. This time, China's fiscal stimulus has a pretty significant focus on what's called new infrastructure. So this includes investments in 5G, industrial Internet of Things. However, there is a significant investment for transportation infrastructure, especially airports and railroads. And different from previous fiscal stimulus from the Chinese government, this time the government also allocated a significant portion to support Chinese consumers, especially in sectors such as autos. In addition, the Chinese government also loosened real estate development and real estate purchasing regulations to allow the sector to come back. Given all these different dynamics, we believe the different sectors in China will recover with very divergent paces over the next 12 to 18 months, and that's shown on this graph. So we believe some of the sectors that are relatively shielded from external headwinds are likely to recover faster. And sectors such as real estate and infrastructure are also going to recover faster because they are better positioned to benefit from the focus of China's fiscal stimulus. However, some sectors are likely to experience a more protracted process of recovery due to their greater exposure to external demand and other factors. As I mentioned, the Chinese economy remains deeply uneven, and that is clearly shown in this graph. This is what I mean. China's industrial production continues to experience much faster growth in its retail sales. This is because Chinese consumers remain highly cautious in terms of spending. And this is at least for two reasons. First, Chinese consumers are still very cautious because they are aware of the potential health hazards related to COVID-19. So the psychological impact continues to affect Chinese consumer behavior, even though the domestic COVID-19 situation has stabilized over the past few weeks. The industrial production is mainly supported by, as I've mentioned, fiscal stimulus from the Chinese government, and that is likely to continue remain this way for the foreseeable future. However, if you look at the breakdown of Chinese retail sales, it shows you a very interesting dynamic, is that despite the overall contraction in consumer spending for the first 8 months of this year, a lot of the reduction in recent months is actually because of the significant decline in services, restaurants, and tourism industries in China because of changing consumer behaviors. If you look at the actual sales of goods, they're actually already back in expansionary territory way earlier than the overall retail sales. Especially, there's also a great divergence between online sales and offline sales as people increasingly adopt the habit of shopping online. And there's continued penetration and development of logistics infrastructure in lower tier cities in China. And we think these are very interesting dynamics for companies to be aware of. And if you look at the demand for different type of consumer goods, you can see that there is a great increased demand for products such as telecommunication equipment, and obviously because people are working from home way more right now and avoiding traveling to go to meetings. So those type of trends post-COVID-19 trends have supported such a demand for telecommunication equipment. When it comes to other sectors, auto also experienced a significant surge in the past few months. A lot of it is because of pent-up demand, but also is because the Chinese government has been giving out more subsidies for people to buy cars. And also, we realized that the Chinese consumers from high income bracket are much less affected in the current economic downturn. And many of them have shown a significant increase in preference for private transportation over public transportation. And also, since a lot of them are stuck at home and can't travel overseas, a lot of these high net worth individuals prefer to drive around the country for their personal travel. And so all these new trends in consumer behaviors have affected demand for different consumer goods. When it comes to the other important driver of the Chinese economy, obviously investment is a key driver. As I've mentioned, the Chinese government has been very generous in fiscal stimulus, but not only that, it has been injecting liquidity into the market and also has been supporting lending for corporates. So what that means is that China's total social financing, a key gauge we can use to monitor China's credit growth, shows you that China's credit growth in August reached its highest level in at least 3 years. And what does that mean? It means that the Chinese government is supporting companies lending, and as a result, we believe Chinese firms' capex will continue to recover, driven by this increase in liquidity. And you may wonder, where does all the money go to, given all the increase in credit growth? As you can see, if you look at the most important sectors in the Chinese economy and investments that go to these different sectors, it's pretty clear to us that the current the current surge in investment in China is mainly driven by investments in two sectors, namely infrastructure and real estate. As you can see, the year-on-year accumulated fixed investment in real estate already overseeded by around 4% of its level during the same period last year. And when it comes to infrastructure, it's also pretty much near expansionary territory on an accumulated year-on-year basis. However, you may notice that manufacturing investment remains deeply in contraction territory on a year-on-year accumulated basis. It's still around -9 or 8%, even though we're already the data is by the end of August, which means that the manufacturing industry is really experiencing a pretty significant crunch in terms of investment. I mean, a lot of it also has to do with lower export demand. A lot of it has to do with the fact that many of these smaller companies in the manufacturing sector have a more limited access to credit compared to their peers in the infrastructure and real estate sector, which are dominated by state-owned enterprises. And what that means for many industrial firms in China is that the inventory levels remain relatively high, considering that the current economic recovery is mainly driven from the supply side. Companies and factories in China are still churning out a lot of products, but they may not be able to sell them as fast as they want to. As you can see in this chart, that the inventory to sales ratio remains significantly higher than the levels of the past 2 years. Especially noticeable is the trend from June to July, which is the latest data. It really showed that the line has flattened out. It failed to continue declining as people wish it to be, and this shows you that there's still significant constraints in demand recovery, and that the current demand recovery may have met some kind of bottleneck for the demand recovery to accelerate. as a result, we believe that many companies in China will still face sort of insufficient market demand, which means that they're likely to experience continued pricing pressure. This is explained very well by the producer price index, which shows you the pricing pressure for products at factory gates, which means that even now, by the end of August, industrial firms in China still have to reduce their products, reduce the price for their products by about roughly 2% in order to sell them, given the let's say insufficient market demand recovery. As a result, we do expect the producer price index to remain in contraction territory over the rest of this year. However, fortunately, it is in the process of recovering. So companies are likely to experience a slow recovery or a slow gradual reduction of pricing pressure over the next few months. And it's very important for companies to take notice of this and to consider the potential implications for the pricing of their products when they sell to their B2B customers. Finally, we would like to talk about something that's slightly more forward-looking. What this means is we want to tell you that given all these dynamics we've talked about, the dampened demand in the external environment, the ongoing US-China decoupling, as well as shifting supply chain, given the revelation of COVID-19, many companies realize that it might be in their interest to reduce dependency on China. And so all these external factors are driving Chinese policymakers to shift toward China's domestic market. And what do I mean by that? It means that the Chinese leaders are likely to invest heavily in the domestic industry to shield the economy against external headwinds. What this also means, given the increased export restrictions from the United States and the potential shifting in supply chain away from China, the Chinese government has a stronger incentive to create the resilience within China's own supply chain, so that it would be some form of import substitution industrialization, so that the domestic economy will be less dependent on suppliers overseas. It also means greater investment in areas like digital technology, automation, to promote industrial upgrade in China. But by the way, this is already happening. It has been happening over the past few years, but because of what happened recently, we think this trend is likely to accelerate over the next few years. And what that means on the structure of the economy means that the Chinese economy is going to shift even more toward a reliance on domestic demand, and also an increased shift toward the industrial and manufacturing sector, and slightly away from the non-tradable or infrastructure and real estate sector. And just to be fair, this is not something completely new. This has been ongoing for a while. However, also because of COVID-19, the company had to sort of compromise and focus on infrastructure and real estate, at least for now, because the economy is in such bad shape. But over the longer term, once the economy stabilizes, it's likely to gradually move away and toward the manufacturing and industrial sector, which is already shown recently as the Chinese government tightened real estate financing to avoid creating bubbles and reduce the credit risks in the real estate sector. And what this will mean is that in about a month from now, during the China's Politburo meeting, Chinese leaders are likely to put a lot of these proposals in the next 5-year plan, which is the 14th 5-year plan, which will be approved by the National People's Congress early next year. And this will set the economic agenda for the Chinese economy over the next 5 years. So firms operating in China can expect an accelerated focus on the domestic economy over the next few years. And this means the Chinese government is likely going to give more subsidies to companies that focus on the domestic market and reduce subsidy support for export-oriented firms in China. And with that said, let's move on to the next market, which is Japan. As we mentioned earlier, Japan, unfortunately, is going to be the most badly hit economy in the Northeast Asian region. And COVID-19 is pushing Japan into its deepest recession since at least World War II. This year, we expect the Japanese economy to decline by about 5.3% before ticking up to 3.3% in 2021. Obviously, the COVID-19 has had a significant impact on both consumer sentiment and investment sentiment in Japan. And despite the government's fiscal stimulus package, domestic demand remains pretty weak. This is shown both on the consumer side and the industrial sector. Furthermore, to add salt to injury, the resurgence of COVID-19 in Japan over the past few weeks have also have further dampened all these demand fundamentals we've talked about. So all these elements will further weigh on the recovery in Japan this year. And looking at the shape of Japan's economic recovery, we already witnessed the deepest contraction of the Japanese economy since the World War II in the second quarter. For the quarter we're in, we do expect the worst is over for Japan, given that the government avoided a stringent lockdown of the economy. However, the economy is still going to contract by almost 7% in the current quarter. And then over the next 2 quarters, we expect the economy to remain in contractionary territory before finally ticking up to expansionary territory in the second quarter of next year. However, if you look at the absolute terms of the economy, because of the huge shock on the economy, we expect the economy to remain below its 2019 level until the end of next year. And so this has pretty significant implications for companies operating in that market. Some of you may question, why is Japan so vulnerable to such external shocks, such as COVID-19, compared to other markets? We expect this is mainly because the Japanese economy is very much focused on domestically produced services, and the COVID-19 has a particular or a disproportional impact on the service sector and the consumption sector for economies. And because of that dynamic, the Japanese economy has experienced a more significant hit compared to other economies because of the protracted impact on employment, wages, as well as consumer sentiment. And so in order to support and shore up the Japanese economy, the Abe administration has enacted 2 fiscal stimulus packages, which account for about 40% of Japan's GDP, and that makes its fiscal stimulus the second largest in the world. And right now, the new administration under Suga is considering the potential of a 3rd stimulus package, and all of these elements we believe will support the Japanese economic recovery. If you look at the current 2 fiscal stimulus, they have a pretty significant focus on supporting Japanese consumers as well as Japanese corporates. So as you can see, for the 1st stimulus package, the Japanese government gave out a pretty generous cash handout to residents in Japan. So each resident in Japan actually got about $950, and that will, we believe, will support consumer spending, at least for the time being. And then the second fiscal stimulus package had a heavier focus on supporting Japanese corporates. This means both cash injections for companies as well as providing rent support and other types of subsidies, such as employment subsidy. However, Abe's health conditions quickly declined in the past month or two, and his sudden resignation led to a political transition in Japan. So right now, Prime Minister Yoshihide Suga is the new prime minister in Japan. So many companies would question what implications or outcome would that lead to. What we think is that firms can largely expect policy continuity from Prime Minister Suga, and this is mainly because Suga is seen as a Abe loyalist. He's also from the same political party, the LDP in Japan, Liberal Democratic Party, and he's very closely aligned and supportive of Abenomics. And recently, he has mentioned that there will not be any VAT hike in 10 years. So remember last year, VAT hike at the beginning of Q4 sent the Japanese economy into contraction territory because of the significant impact on Japanese consumers. So the economy will be further hit if there's a VAT hike in the near future. And so he basically backtracked his previous position and decided to not have a VAT hike in at least a decade in Japan. And we think that is good news for B2C companies. In addition to that, we believe he's going to maintain the current political structure and will not call for parliamentary elections until at least the fall of 2021. This means that companies should expect policy continuity over the next 10 to 12 months. And put that in practical terms, what it means is that the Bank of Japan will continue to maintain relatively low or negative interest rates, and that will support corporate lending in the country and keep interest low. Secondly, we also think that this will help to stabilize the Japanese yen. So we think the Japanese yen will remain stable over the next 12 to 18 months. In addition to that, Suga expressed his willingness to resolve trade disputes with South Korea, and we think that is positive for the trade sector in Japan as well. So given what we've talked about, different sectors in Japan will likely recover at different rates over the next 12 to 18 months. Notably, many companies, especially B2C companies, are very concerned about the prospect of hosting the Tokyo Olympics in 2021. Our recent analysis shows that it would be very difficult, if not impossible, for Japan to host the 2021 or host the Tokyo Olympics in 2021. Even though the Japanese government, as well as the International Olympic Committee, are still pretty committed to hosting the games, but because of the global pandemic outbreak, as well as the uncertainties regarding the production and distribution of an effective vaccine, we think hosting such games in Q2, Q3 next year would be very difficult. And so there are a lot of uncertainties on that front. As such, we think companies should expect a slow and protracted recovery in both consumer and industrial sectors in Japan over the next 12 to 18 months. So companies should not expect a pre-COVID level of economic activities in Japan until at least Q3 of 2021 for most sectors. And obviously, needless to say, the tourism and hospitality sector will experience a further delay in recovery given the difficulties and restrictions on international tourism. And looking at the internal dynamics of the Japanese economy, obviously Japan's consumer confidence dipped to its lowest level during the peak of COVID-19 during the second quarter of this year. Recently, Japan's consumer confidence recovered substantially. However, it still remains below its normal trajectory. So we think because of that, because of the pessimism among Japanese consumers, we don't expect a sudden recovery or surge in consumer spending in Japan over the next few months. And that is obviously exacerbated by the second wave COVID-19 infections, which has weighed heavily on Japan's labor market. As you can see, Japan's historically low unemployment ticked up during COVID-19, even though it remains pretty low compared to many other developed economies, but nonetheless a much higher number than its unemployment over the past 2 years. Also, I need to mention that Japan's unemployment rate doesn't really account for layovers, so we think this actually is an underestimate of the labor market situation in the country. And then when it comes to Japan's industrial sector, obviously the dampened global demand has weighed on Japanese exports, and that will translate into greater pessimism on Japanese manufacturers. As you can see, Japan's Purchasing Managers Index remained below the line that separates expansion versus contraction. It has recovered since the end of June. However, you can see between August and September, it kind of really flattened out given the significant uncertainties of global economic recovery. And then another factor is that both industrial production and consumption in Japan remain below the baseline, which means that they're still both contracting. What that means that this is likely to delay Japan's economic recovery, and this doesn't really have the data in August, and because the height of Japan's second wave has actually occurred in August, which we think will likely have further dampened retail sales in Japan. And with that said, let's move on to our next market, which is South Korea. Many people will wonder, given that there are many similarities between the Japanese and Korean economies, how come South Korea has managed to be so resilient compared to its neighbor Japan? And we'll explain that now. We expect the South Korean economy to dip into contraction territory, however, but only 1.4% this year, and that is a much smaller contraction compared to most advanced economies. And next year, we expect the economy to tick up to around 3.3%, which is pretty much back to Korea's normal economic trajectory. And similar to other economies, the Korean economy is going to experience a pretty significant negative impact on investments, consumer spending, as well as exports. And then also the Korean government has taken some positive actions to support its economy, which we think it has had a pretty positive impact so far. Looking ahead, we do expect continued consumption recovery on the top of a relatively resilient labor market. However, despite its current success in containing COVID-19, the potential for winter COVID resurgence is a great risk for its economic recovery. Finally, we think that the Moon administration's fiscal stimulus package, especially an expected package for the next 2 to 3 years, will also put the economy on a path of stable economic recovery. Look at the shape of Korea's economic recovery. We do expect that the worst is over for the Korean economy as it gradually comes out of negatory or contractionary territory, and we expect the Korean economy to log positive growth by Q1 of 2021. If you look at the absolute terms of the Korean economy, we expect the Korean economy to come out to get oversee the 2019 level about the third quarter of 2021 at the latest. What this means is that the Korean economy is going to recover much faster than Japan. And a lot of it has to do with the fact that the Korean authorities have been extremely supportive in both physical stimulus as well as monetary policy. As you can see, the Korean Central Bank has consistently been lowering interest rate for Korean corporates, which has reached its lowest level since at least the Asian financial crisis. So what this means for a lot of your channel partners as well as clients is that this will be a good opportunity for them to invest or take in stocks, given that we are at least temporarily in a low interest environment in Korea. That is not going to last forever. And we do expect this rate to tick up sometime next year as the economy continues to recover. And what this means is that the internal dynamics and the global economic recovery will have different levels of impact for different sectors in Korea, and as a result, the different sectors are likely to experience divergence in its rate of recovery over the next 12 to 18 months. If you look at this graph, we do believe sectors that are exposed to Korean consumers and domestic consumption are likely to recover much faster than almost all other sectors. This is because, as we will explain later, the Korean consumers have shown pretty strong resilience compared to consumers in both China and Japan. However, we do expect continued, insufficient market recovery to affect Korea's manufacturing industry, especially given the heavy reliance on the international market. And as a result, we believe all these uncertainties associated with the global outbreak, as well as the impact on consumer wage growth and employment in overseas markets, will weigh on Korea's export-oriented sectors. And what do I mean by that? As you can see, the Korean exports have been heavily hit by COVID-19, especially back in the second quarter. Now, over the past 2 months or so, Korea's exports have recovered somewhat from its low point. However, as you can see, in August, it trended lower again because of the potential second wave impact overseas. So looking forward to the next few months, we do believe the Korean economy to continue to experience headwinds for their demand overseas, but however, at a slightly less severe level because of the recovery in global demand, despite the uncertainties. This is also shown in Korea's Purchasing Managers Index, which has been consistently improving over the past 2 to 3 months. This is mostly because of improving export orders as Western economies reopen. Now, again, as we mentioned, there's still great uncertainties on that front, as many economies in the West have experienced significant second wave infections. The daily infections in the UK just surpassed its highest even since the beginning of the pandemic. So we think all these uncertainties will still shape Korea's economic recovery, especially in the industrial sector. As you can see, Korea's industrial production experienced a great contraction in April and May, and since then has gradually improved due to global economic reopening. What's particularly interesting here, as you can see, in February and March, the Korean industrial sector experienced a surge in output. And why is that so? According to our analysis, it's actually because so many of Koreans' exports are somewhat substitutional compared with Chinese exports, especially in the telecommunications and electronics space. So the fact that the Chinese industry was pretty much froze during the height of the pandemic, that actually has helped to boost Korean exports. And as soon as Chinese factories got back online during April and May, that sent a greater shock to the Korean economy, just because people then could opt for Chinese exports compared to Korean exports. So I think this is a particularly interesting dynamic. So over the coming months, we do expect Korea's industrial production to gradually recover. However, there are still heightened uncertainties we've mentioned previously, especially on the external front. When it comes to Korean consumers, which is probably a particular highlight for the Korean economy, consumer confidence has been consistently improving since the Moon administration ended its lockdown or lifted social distancing restrictions in May. Now, despite the second wave infections in Korea, the Korean consumer confidence remained relatively resilient. We think that is because the Moon administration has avoided a lockdown this time. And also, as the government gets better in containing the virus, it managed to reduce the economic impact by avoiding such lockdowns or social distancing measures. Instead, the Korean government focuses on other tactics that can help to contain the virus, such as aggressive testing and pretty stringent quarantine and community-based lockdowns. So we think based on these reasons, we do expect a continued recovery of the Korean consumption over the next few months. This is somewhat shown in Korea's retail sales growth. As you can see, as the Korean government ended the lockdown measures, there's a significant uptick in retail sales in Korea in both May and June. Obviously, a lot of it, the exponential growth in June has to do with pent-up demand, but nonetheless, we do expect Korea's retail sales to remain in expansion territory over the next few months, just because of the measures taken by the government, its effective containment of the coronavirus, as well as a resilient labor market, which has supported Korea's consumer confidence. However, we don't expect a significant surge because of the impact of COVID-19, and that will shape consumer behaviors in Korea. So while we expect it to be in expansion territory, we expect that growth to be relatively mild compared to previous years. Now, we look at Korean's consumer price index, which also tells you a similar story that the domestic demand is recovering following the containment of COVID-19 and following the successful containment of the second wave infections. So all these policy response will support Korea's demand recovery in Q4, as well as into next year. Finally, we've mentioned the Korean labor market is extremely resilient compared to many other markets, and this is shown in Korea's unemployment rate, which actually lowered to its lowest level since at least the global financial crisis. We think this is a positive sign that the Korean employers have the Korean business sentiment has improved over time, and also we think the Moon administration's fiscal stimulus package has also significantly helped to shore up the Korea's labor market as well as employment. And with that said, I'd like to turn things over to Althea and see if we have any questions from our audience.
Fantastic insights. Thank you, Boyoung. We would now like to begin the Q&A portion of the webinar. If you have any questions, please share them with us via the GoToWebinar messenger by sending your questions to Dr. Frontier Webinar. Boyoung, here is the first question from the audience. Do you expect US-China tensions to heighten next year? And how would that affect China's GDP growth in 2021?
Well, thank you for that question. This is a brilliant question. Obviously, there are still uncertainties regarding US-China tensions for the foreseeable future. But in our base case, we do believe that candidate Biden has a higher chance of winning the elections. And if he wins the presidential race, that is likely to affect US-China relations compared to a second term under President Trump. This is because we believe Biden is less likely to take punitive tariff increases on Chinese exports or Chinese imports for the United States. And so in that case, we expect less economic damage for the Chinese economy. We do expect a Biden presidency to maintain the current levels of tariffs with the United States, and which is our current base case. So in this case, we don't expect it to significantly weigh on our current trajectory for China's growth in 2021. However, if we have a Trump presidency a second term, there is great potential for increase in US tariffs for Chinese exports. And in that scenario, we may have to further revise down our forecast for China's GDP growth for next year.
Thank you, Boyoung. We do have another question from the group. What's your currency view for these three markets in Northeast Asia in 2021?
Thanks for that question. It's a great question since we haven't talked about currency so far in today's presentation. What we think is that for the Chinese RMB, recently it has been strengthening slightly compared to the US dollar. And we think that is likely to remain so until at least November or toward the end of this year. So the RMB will remain stable or toward mild appreciation for the next few weeks or months. However, for 2021, do expect the Chinese RMB to weaken against the US dollar. This is mainly because we do expect continued confrontation and tensions between China and the United States. And we believe some of the elements that support the RMB right now are likely to be temporary. For example, the phase one trade deal is still in place. For example, the divergence in growth between China and other markets. So these elements have supported the RMB. So next year, some of these dynamics will change, And then, especially because of rising US-China tensions next year, following the elections, we do believe the RMB to depreciate next year from its current level. So our estimate for next year is the RMB will average around 7.2 versus the US dollar. Now, when it comes to the Japanese yen, as we've briefly mentioned earlier, because Suga is a policy continuity guy, and he's likely to maintain Abe-era economic policies on the monetary and fiscal front. As a result, we do believe the Japanese yen to remain relatively stable with slight and mild appreciation over the course of the next 12 to 18 months. In addition to that, this is also because when there are volatilities around the globe, the Japanese yen is seen as a safe haven for assets. And as a result, we think these dynamics will support stability and with slight and mild appreciation for the Japanese yen. When it comes to the Korean won, it has a similar dynamic with Chinese RMB. Given the close linkages of these two economies, and given that these two economies are comparatively in a better shape than many of their peers in the global market, so as a result, the Korean won has also recently been slightly appreciating. We think, similar to the RMB, is current appreciation is going to be relatively temporary, which means it will last until about the end of this year. Next year, we think it will likely depreciate along with the RMB by a 5 to 10, well, around 5% margin going into next year because of rising US-China tensions, and also because the exposure the Korean economy has to the Chinese economy, especially in related sectors such as semiconductor and electronics. And so finally, so just to summarize, we think next year the RMB will slightly depreciate. The Japanese yen will remain relatively stable with slightly mild appreciation, and the Korean won will also, along with the RMB, depreciate slightly in 2021.
All right. Thank you, Boyang. We're nearing our time limit for today's webinar. If there were any questions that we were unable to answer on the line today, we will be sure to follow up with responses through your client services manager. Everyone will also receive a recording of the presentation within 24 hours. You can view this webinar materials and much more on our new mobile app, which is available for download right now on iOS or Android. For complimentary access to our suite of resources, including data, dashboard tools, and market monitoring reports, please email us at info@darkerfrontier.com, and a member of our team will be in touch with you. Thank you everyone on the line for joining us. We look forward to speaking with you again soon.